Hello and welcome to the Rask Network. What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information. Billy, thanks for joining me on the podcast.
Thank you.
First time we've met in person, which is always good fun. To do it in person in Melbourne, my neck of the woods, my home ground, mate. It's good to have you.
And also I grew up here as well, so it's very nice to be here.
Yeah, good to be back. So I've got a few icebreakers for you. You've been on the show a lot. We've talked about all different types of stuff. We've talked about fundamental research, how you went about that. We talk about top-down, talk about different types of thematics over the years. So we can put links in the show notes to previous conversations we've had. First question, a bit different, icebreaker, is who's the smartest person you've ever met?
Yeah, so what I really enjoy or what I really like about people is when they can, find ways to, improve or make money with nothing. You know, it's always about arbitrage for me. So when people say, what is the smartest guy? Who's the smartest person? It always reminds me of someone I met, when I was in China, like a hawker. He actually went and found, parts and pieces of like bottle caps. He went to find little, twigs, and he actually made things out of all these, and he sold it. So I guess, when I say this, it's because I like it when people are able to, with a very low cost or zero cost, able to actually make money. And he was probably one person I really liked. And I went, wow, I talked to him for about, half an hour. He was like, this is how I make money from nothing, essentially. And I went, this is actually a very, very smart way to do things. And, we see this in the market right now where people try to, go from very, very zero cost or low cost in order to create value.
Yeah, great. That's interesting. We're just talking off air about a lot of your experiences in Hong Kong and China and places like that. Okay, another icebreaker for you is who's been a mentor in your career?
Yeah. So I think it's definitely one of my first bosses. He was an investment banker. He was very tough and he taught me a few things and it still resonates right now. So I still remember a few things he said. I think one thing he said was, Billy, there's only one way to do things and it's the right way. And I like that. It's because he believes in, hard work. He believes in grit. And I believe in that as well. There's no shortcut in life. And I still go by that. And he also taught me one thing was, Billy, I always ask him something, when is it due? And he's always saying, Billy, everything's due yesterday. So I think, he was, I want to say mentor, but, these two things still resonate with me after, about 15 years of work.
That's great. I often think that the first boss that you have is the most impressionable. Yeah, and it's good when you pick someone that is able to be that for you in the right way. And as you say, investment banking generally can be a pretty tough gig. So I'm glad you found someone good in your life. Okay, who's one investor? This might be a bit more challenging. Who's one investor that you think is really underrated?
Yeah, I don't know if he's underrated, but he's probably not as well spoken by a lot of people. But I'm not sure if you heard of Nassim Taleb.
Yeah.
So he writes obviously, but what I like about him is I guess he addresses the tail risk. I'm always about risk. I think with investments right now, with modern investing in a lot of analysts, which I've seen in the past sort of 5 to 10 years, everyone looks at the upside, but no one addresses the downside risk. And I think for Nassim Taleb, he obviously addresses the black swan, the tail risk, and I think that's very important. And to me, he's one person that I really respect because he addresses it and in a very logical manner as well.
Yeah, that's really interesting. He just did a great discussion with Joseph Walker. Shout out to the Joseph Walker podcast, Australian podcast. And Nassim was on there for about 2 hours and it was a fantastic discussion. So if anyone's looking for extra resources, good pick, mate. Okay, so I love this quote that markets climb a wall of worry. And if you look around the world, there's always something to worry about. Even here at home, there's something to worry about, whether it's in the US, a presidential election, whether it's some sort of consumption thing that's going on or something in Europe and the UK, here in Australia, it's like, well, how do we go with trade? What are interest rates doing? Property, so many things to worry about. So I really like that phrase. But if you could describe the macro environment over the past year, say, what would it be telling you?
I think if you just look at probably the past year or even year to date, I think there's sort of one thing that we definitely say is volatility. It was volatile. And this is really interesting because if you look at the volatility in the past year, it's actually been rising, but this is going to peak. This has peaked, and this goes back to your observation that we're climbing a wall of worry because people are always concerned about what they don't know. And what we've seen in the past, I guess, 2 weeks is that we've had 3 major clearing events. So we've cleared off the US presidential election. Mm-hmm. We've cleared off where FOMC or where the Feds are heading. And we've cleared off a major hurdle, which is actually the Q3 US earnings. So this is 3 major parts. And when we've cleared this, I think the past volatility, I think, has peaked. So I would address sort of the past year as in it's been very volatile and very easy for investing. And I would actually say going forward, it's going to be less volatile, but actually harder in terms of picking your stocks, picking your themes, picking your areas of investments.
Interesting. So you think volatility brings opportunity?
It does, but also exactly. And so low volatility means you have to be much more prudent in terms of what you select. And it's not, I guess, I hate to say this, but a one-way street. It's no longer like that anymore.
So probably the biggest thing for me on this is that the last maybe 3 months, maybe to be honest, the last 5 years, there's been the US market's really expensive. The people, wheel out the CAPE ratio as, which is a PE ratio basically for people that don't know. And they'll look at these different things and they'll say, it's very expensive, blah, 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 blah. But the US market just seems to just keep powering ahead. How do you think about that?
Yeah, so I think what investors or what the market needs to understand is that everything's still relative. If you're not putting your money in bonds, if you're not putting money in commodities, it's going to go into equities. And how I see it is that equities is still providing a lot of alpha, a lot of growth right now. So I would say that, in the past few years, it's because equities has been the preferred asset class. And that has been true. But to me, it's also about because, there is that going forward of US exceptionalism. We have seen US, disrupting supply chains. We have seen US dollar being a very strong. And it's also about the US growth being relatively better than elsewhere. So obviously we've seen China going through their route of debt issues. We've seen the EU or major parts of Europe going through their potential even recession. So it's all about relativity, asset class, and also geographically. And I would say this is why US has been doing so well because it's relatively doing better than elsewhere.
Interesting. How do you look at the US market? Just as like a follow-up to this, like if someone does say it's expensive and you say, yeah, relative to other things, are you looking, when you make that call, are you looking at earnings growth? Are you looking at is that like 1 year, 5 years? Like how do you assess it?
Yeah, so I think you mentioned about valuation. I mean, even on a PEG basis, a price earnings versus growth basis, there's still some very attractive areas in the US as well. We've seen it in obviously artificial intelligence. We've seen it in areas such as semiconductors and even the software as well. So there is also that value for growth, so bang for buck. So we are still seeing that, which is why it's important. But it's also very important to understand that there is that productivity gain that's coming up in US as well. And I think we've discussed this in terms of artificial intelligence. Productivity gain is also a very strong driver of not earnings, but valuation. So if you look in the past, I guess 10 to 20 years, US earnings has been driving stock, but it's also the re-rating. We've seen PE ratio go up from about 16 times to about 22 times right now. So because of productivity gains, better margins, this is also driving the equity market. And people need to realize that it's not about earnings growth, but also about there's this profitability and sustainability, and which is why it's getting more, I guess, inverted commas, expensive.
How do you think about, say, the US election just being done and dusted? You said that's like one major thing that's been ticked off, right? How much does that play into your expectations for what happens? Because like a lot of people before the election were like, it's so uncertain. Donald Trump, they think back to like 2020 where there was like that Capitol building issue, let's say, put it mildly. Like they think about this and it just seems really polarizing. So like now you look at the market and you think, is it too late to get in? Like, how do you think about that, generally speaking?
Yeah, so that's a really tough question as well. But I think the first thing to note is that going into the election, there was already a very high expectation that there was going to be a Trump administration. I think the misunderstanding was, people thought it was 50-50. A lot of the odds were like that. But if you looked at what, I guess, the bonds market or the FX market, they were pricing close to about 70 to 80% of a Trump administration or a potential Trump presidency. So, the thing is, going to it, there was a lot of positions of this trade as well. So I think that's one thing to know. But so what I'm trying to say is going afterwards, people do understand what Trump means. Okay. So, we are going to expect a stronger US dollar. We're going to see deregulation, potentially diminishing impact of the Feds and FOMC. And we are going to see a major disruption in global supply chain. And we have discussed this before. But I think the key thing to know is that there is going to be a lot of inflationary problems. And this is going to be probably a bigger discussion for us, is no one has ever addressed the S word, which is stagflation. And why I say this is because we are entering a period where obviously we've seen very high growth in the past decade, but we're going to see a slower growth, not no growth, but slower growth in the next decade. And what Trump and potentially other administration is going to face is that he's going to be very pro-growth. So he's trying to bring out growth, lower tax, which is inflationary. There's also supply chain disruption, which is going to be inflationary. There's also geopolitical concerns, which is going to be inflationary. But at the same time, there's going to be low growth. And when I discuss this with a lot of clients, they've never seen low growth and high rates. And this is what we call stagflation. And so this is probably a tail risk, which I see. And, to answer your question, something that we're going to see in the next Trump administration is how he's going to deal with this potential stagflation risk.
I hadn't thought about that. So let's play a bit of scenario analysis here. If we see stagflation or even just a resumption of reasonable inflation, let's just put it that way, right? So there's this kind of persistent inflation because he wants to lower taxes, he wants to increase productivity and spending. What does that mean for a portfolio? And feel free to use like a global product as an example. Like how does that like tilt or change a core portfolio or a tactical portfolio?
Yeah. So look, the portfolio has a lot of possibilities, but what I would say from a more sort of broader perspective, during stagflation, what really happens is companies which have a lot of cash, companies which are generating free cash flow, companies which are generating high margins, these are the companies that are going to not benefit, but just last. And so I would say if this is true, and I'm not saying there's definitely a high percentage of stagflation, but if there is a stagflation environment, I would suggest that we go for quality names, quality portfolio ETFs, and this would be much more resilient in the next 5 to 10 years. And the reason is because when you look at companies where there's high cash flow, well, A, they're going to be more sustainable, but B, during a environment where there's no growth, but they have a whole lot of cash, these companies usually return wealth to shareholders. So either in the way of dividends or either in the way of buying back shares. So there's a lot of wealth return. So you will benefit from it. And the interesting thing is we are seeing that it's because even tech companies are now starting to pay dividends or buy back shares. And no one realizes this. They're like going, oh, why are tech companies doing this? And it's because they see this going forward because there's less room for investment. And I'm not saying innovation's over, but I'm saying it's all about relativity. Growth was high, a lot of investments in the past decade, but it's just going to be relatively less in the next decade, which is why they're doing more wealth return. And so I would suggest for a portfolio, look for areas or companies or ETFs with high cash, with high free cash flow, with high profit margins.
Yeah, interesting. I'm thinking then on the defensive side and the income side, like the traditional defensive side, having products which are more like inflation linked, floating rates, those types of things might also help with the variability that comes with that. What do you think about so say for example, if we go back to the question I had before about the wall of worry, there's always something for someone to worry about. So if you think like in this specific era, as we go into we'll talk through the lens of like Trump administration, like more kind of, I guess, open business, pro-business type of administration and policies coming down the pike. are there other biases that might creep in, or are there biases now that you're noticing with investors as you talk to them?
In terms of asset classes, or
yeah, just in general, because like if you think about it, like 6 months ago, people were so scared of like fear of the unknown, fear of like Trump, and that I'll wait and I'll get in the future, you know. But now it's happened. Like, I'm curious if you come across people like, are they holding off? Are they investing more?
Yeah, no, you're correct. I think, like I said, the US election was a major clearing event, and I do think there is a level where people do want to now come back in, which is why I'm still in the near term, I guess, positive on equities, despite the fact that I do believe there's stagflation possibility. But what I would also say is that in terms of what clients or what I'm talking to investors with is, you know, there was a lot of positioning ahead of the election. So right now it's about, okay, we know that there is a lot of pro-growth. We know there's a lot of risk on. Which sectors are actually underperformed or has been lagging? And so this is what I really like because, you know, from my background as active investing and trading, I always look for potential for arbitrage. And how I see it is which areas or sectors have not gone up as much as the potential market. And this goes back to our previous question of, you know, why I like companies such as software. It's because if you look at the past 12 months, artificial intelligence, AI has been a big theme. And a lot of these companies that actually appreciate it was actually hardware companies like semiconductors, right?
Yeah.
But if you look at software, they've actually been underperforming in the past 12 months. And we've actually seen a lot of software companies now catching up right now. So I would say one key thing is, well, A, look for laggards. And B, one of the key lagging areas has actually been software. Software is, like I said, they've high growth. They've got high profitability. You know, they're very resilient during times of, you know, low growth. And they've been lagging the past 12 months. So this is an area I would definitely focus on in the next 12 to 24 months.
Interesting, because it's kind of like the Magnificent Seven, right? They have just been flying ahead. But then there's like this whole branch of companies that are like down underneath that are just so impressive, but people don't pay nearly enough attention to.
Exactly.
And in that same technology space.
Exactly. And this is what I've also been talking internally and also externally as well, that, you know, we are going to see a broadening of performances. So I'm not saying the Mag 7 won't do well, but in terms of the S&P 493, we're going to see, you know, a lot of these companies benefiting or catching up, you know, like this laggard trade I'm talking about. And especially during a Trump administration where we're going to see potentially pro-growth, lower tax, this is going to be very good for a broadening trade. And again, this is why we've seen, you know, smaller caps and also even Russell 2000 outperforming. It's because exactly what we just discussed.
Yeah, that's interesting. So Mitch wanted me to ask you a question, which is a bit of fun, right? And he put it slightly differently. He said, with Elon now thoroughly embedded in the White House, for people that haven't seen the news recently, there's a lot of Elon involvement. There's a few other characters leading certain things. He's given me a hypothetical to give to you, Billy. He says, you must invest in one of these for the next 4 years. ARK, which is the innovation ETF, or SARK, which I think is the twice inverse levered, so it would go the opposite direction. Which one would you choose over 4 years?
It's going to be ARK. I'm very pro-growth. I'm very pro-innovation as well. I mean, despite the potential tail risk, I do believe in productivity. I think, you know, the risk to my stagflation argument is that if productivity improves, this is what's going to offset or prove my view wrong. And so I would be very, very pro ARK at this point because it is all about productivity innovation.
Interesting. Yeah, I like that. So I wanted to ask this question earlier, but I've waited till now. Is if you could, because I kind of asked you about this off air, but it doesn't have to be the same thing you and I were just chatting about. But if you had to pick one or more themes, like you mentioned that kind of productivity is really important, but also the stagflation thing, like underneath the laggards and that type of area, if you had to pick an ETF or even just broadly the theme which you've mentioned, what would that be? What should our community, what should I be walking away from this conversation thinking, I'm going to go and look at that. I'm going to go and explore that. That's really interesting.
Yeah. And yes, and I do have one, and sorry for stepping back, but you know, how I and even Global X approaches thematic investing or looking for themes is, you know, we look for three key criteria or factors. The first one is we believe that there needs to be a major advancement in technology. Mm-hmm. There needs to be a major change in the environment or regulations. and there needs to be a major shift in demographics. We believe that it's the convergence, the combination of these three factors, which create a major disruption or a major trend. And having said that, one thing that I do really have high conviction on is the cybersecurity sector, which is why I've been discussing with clients about the Global X Cybersecurity ETF, which is the ticker is BUG, BUGG, very nicely named.
Absolutely.
And the reason is because just applying that framework, I was saying is, one, there has been a lot of, I guess, advancement in technology, both on the good side and the bad side. Artificial intelligence has increased the threat we're facing now in terms of cybersecurity attacks, but it's also improved the resilience of cybersecurity. So, for example, Darktrace is a major cybersecurity company. They've applied artificial intelligence, AI, into adopting behaviors of users and companies in order to react to threats. So it's made it much faster to react to cybersecurity attacks. What's also happened in the sort of environment and regulation is that we're seeing governments increasingly more concerned with cyber threats. So, for example, in the US, the amount that's allocated to R&D for cybersecurity has been one of the fastest expanding sort of parts of the US Department of Defense in the past 4 years. So they know about this and they're investing heavily into this. So I usually see that, when the government invests, the private sector will follow. And lastly, I think in terms of, when I mentioned demographic shifts, it's the awareness of cyber attacks. And I call this the 1,000th paper cut. It doesn't hurt until it really hurts. And I think we're getting to a level where it's the 1,000th paper cut. So for example, IBM did a research where in the past 10 years, the average cost of a cyber threat went up from $3.5 million US to $4.5 million. So it's increasing. What we've also seen is that the largest 3 cybersecurity attacks in history happened in the past 2 years. So what we're seeing now is that cyber threats are more frequent and much larger. And I think that's going to be impacting a lot of things. So it's because of these sort of 3 factors. We've seen technology, AI, we've seen government spending, and we've seen awareness. I do believe that these 3 factors have converged into creating a sort of very good, a tailwind for cybersecurity. And, which is why a lot of interest in our cybersecurity ETF.
Yeah. That makes a lot of sense. I've got the companies up here like Fortinet, CrowdStrike, which had the outage recently. It's crazy how resilient that's been.
Yes.
Zscaler, Palo Alto Networks, like the list goes on.
And that also goes back to our discussion about, even going into the next 5 to 10 years, if we see lower growth, it's software companies which have recurring revenue, high margins. These are the companies that are going to be much more resilient in this kind of times. And it just blends well into what we've just been discussing.
Yeah. So that's BUG, BUGG. So you've got young kids that we're just talking about off air, and because you're a Melbourneite originally, now you're in Sydney. That's okay. We won't hold it against you, mate. No, that's great. How do you invest for them?
Yeah. So I truly believe in compounding. I truly believe in compounding, and I teach my kids that as well. And I'm sure the rule of 72. Whenever you look at a return, what is it when you divide it by 72? And that's when you double your amount. So, if you have a 9% per annual return, you double your amount in 8 years. So for me, it's a lot about, finding that potential area of doubling, in a short period of time. For me, I like property. Mm-hmm. I do believe in compounding in property as well. It creates a lot of return as well. In terms of, I guess, like I said, ETFs, it's also about, selecting the right places where there is growth and, really looking for that compounding effect, not looking for the short term, this is, going to give us 20%, but looking for that consistent 8%, 9% return per annum. So, which is why, we've discussed a lot, about themes which are much more longer, 5 to 10 years.
Yeah, that's great. A lot of people, the first thing they think of when they think of investing for kids, the first thing everyone thinks of is tax. But I feel like it's probably putting it's the tail wagging the dog here, is that probably put that aside. Even if they get taxed, they're taxed because, even if it's in the parent's name, They're taxed because they're making money,
Yep.
which at the end of the day is probably the first and most important consideration.
Yeah, it is. I mean, like whenever I look at investing, like tax is obviously a really big issue. We have to address it, but it's also about things that you have to take out. It's like a litmus test. These things don't matter. What you have to look at is if you increase the return, these things matter less and less and less and less. So I think it's all about looking at sort of what are the potential upside, and then these things you can't remove.
Yeah, that's fair. So I've got, I'll put a link in the show notes to Bug as well as some of the other conversations we've had in the past about AI. And I know you did one recently with Mitchell because there's just so much research on the Global X website as well. I've got one final question, which is on the kids angle. And again, this is a Mitchell special. The reason I bring that up because I think he was trying to get some investing for kids tips from you. If you were to teach them about investing or even about business, like not necessarily like straight into a discounted cash flow analysis for you, but just about investing, business, and being more worldly in that respect, what would you hand to them?
I don't know. I think I'm a big believer in addressing risks, especially downside risk, and I don't believe this has been taught enough. I think one thing that I've really enjoyed when my kids grew up was when we read about Winnie the Pooh. I don't know if you've looked at it, but Winnie the Pooh is a great story because we've got different types of personalities. Winnie's very optimistic. We've got Eeyore, who's very pessimistic, and then we've got Tigger, who's obviously very jumpy as well. So what I'm trying to say is that for investors or for teaching young kids, it's always about teaching there's a broad spectrum of what can happen. And I think right now, a lot of the investors, a lot of the market is always looking at what's potentially good, but never look at what's potentially bad. And I think, in Global X, whenever I address clients or talk to clients, it's all about, okay, this could happen, but what can also happen in the downside as well, which is very important. And, we have a wide range of ETFs and it's, they go, look, what is the potential upside? But then there's also the drawdown risks, and we have to address that. So I would say it's more about understanding the broad spectrum of what could happen rather than, all the good things that can happen.
Yeah, I like that. I've never heard someone bring up Winnie the Pooh on a Rask podcast, but I'm glad you did. I'm glad you're the first one to do that. And it illustrates the idea of being worldly and having these concepts in your mind from a young age, which is so important when it comes not just to investing, but just as people mold into young adults. So, well, Billy, this has been heaps of fun. I'm glad we could do this chat in person. First time in person. Hopefully the many more to come. So thanks for joining me.
Thank you.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.